The U.S. Department of Commerce released revised data on May 30, 2024, showing that the real GDP growth rate in the United States for the first quarter of 2024 was annualized at 1.3% quarter-over-quarter, a downward revision of 0.3 percentage points from the preliminary value of 1.6%, and a significant slowdown from the 3.4% growth in the last quarter of 2023. This adjustment was mainly influenced by lower-than-expected personal consumption expenditures, PCE, which grew at an annualized rate of 2% quarter-over-quarter in the first quarter, down from the preliminary estimate of 2.5% and below the market expectation of 2.2%. In terms of inflation, the PCE price index grew at an annualized rate of 3.3% quarter-over-quarter in the first quarter, slightly below the initial forecast. The core PCE price index increased by 3.6%, revised down by 0.1 percentage points from the initial value of 3.7%, and up significantly from 2% in the last quarter of 2023. Although this indicates that inflationary pressures still exist, it also shows that inflation is on a cooling path. The main reason for the slowdown in real GDP growth in the first quarter was a significant weakness in goods spending, especially automobiles, and consumer spending figures were revised downward. Compared to preliminary estimates, exports and government spending slowed. However, residential investment and imports saw a rebound. Following the release of the data, yields on 10-year Treasury bonds briefly fell. Despite the slowdown in economic growth in the first quarter, the latest forecasts indicate that the economic growth rate may reach 3% or higher in the second quarter, suggesting a potential short-term recovery. However, the sustainability and strength of this recovery remain uncertain. Analysts believe that even if GDP rebounds in the second quarter, the U.S. economy is unlikely to show strong momentum in the second half of the year. Consumers have had to dip into their savings to maintain current spending levels, and persistent inflation has weakened their purchasing power. Furthermore, the upcoming presidential election may lead to businesses adopting a more cautious attitude towards spending and investment. The capital markets' expectations for a Federal Reserve rate cut this year have significantly decreased. Market bets on the timing of the first rate cut have been pushed back from September to November, and the probability of a rate cut in September has dropped from 70% to around 50%. Minutes from the Federal Reserve's policy meeting show that most participants believe there is still uncertainty regarding inflation and unanimously agree that recent data has not increased their confidence in inflation falling back to 2%. This indicates that the Federal Reserve will continue to consider inflation as a primary factor in setting monetary policy. However, there are also some optimists. Federal Reserve Governor Christopher Waller holds an optimistic view on the decline in inflation, stating that there is no need for further rate hikes and supporting an early rate cut. Waller stated on May 21 at the Peterson Institute for International Economics that the inflation data for April might have shown progress back towards 2%, indicating that U.S. inflation is not accelerating and that further rate hikes are unnecessary. Waller paid special attention to the non-manufacturing PMI, with the latest data showing that the non-manufacturing PMI, which accounts for the largest proportion of output, fell below 50, reaching the lowest since December 2022, indicating a slowdown in economic activity. He said that if these data continue to weaken over the next 3 to 5 months, the Federal Reserve may have to initiate rate cuts. On the contrary, Federal Reserve Governor Michelle Bowman expects U.S. inflation to remain high over the long term and reiterated that she does not rule out the possibility of restarting rate hikes if forthcoming data indicates that progress in combating inflation has stalled or reversed.